let's talk about the year 2000. It's the absolute screaming peak of the dot-com bubble, and the business world gets completely rocked by the single largest corporate merger in history. It was a deal so huge, it literally redrew the map of global telecommunications. But this legendary takeover, the UK's Vodafone buying Germany's Mannesmann, holds a really fascinating paradox at its core.
Because somehow, this one historic deal was both of these things at the exact same time. It was a brilliant strategic masterstroke that created a global empire, and it was a catastrophic financial disaster that just vaporized shareholder value.
And just to put a number on it, the final price tag was 181 billion euros. That's about 183 billion US dollars back then. I mean, that is a mind-boggling figure, even today. So that's the big question, right? That's the mystery we're going to unpack right now. How on earth could one of the most famous deals in business history be both a massive win and a total disaster? Well, to figure that out, you really have to understand the companies involved. You see, this wasn't just some friendly transaction. No, this was a full-on battle between two completely different corporate philosophies, embodied by two companies with wildly different ideas about who they were. So, over on the left, you've got Vodafone, and you can see from their strategy, they were a pure-play mobile predator, just laser-focused on one thing and one thing only, becoming the global leader in mobile phones. Now, on the right, you have Mannesmann, and just look at this chart. For like 100 years, they were this classic German industrial company, think steel pipes, engineering, that kind of thing. But then, in the 90s, they made this incredible pivot into telecom, and that red line you see shooting for the moon, yeah, that's what put them right in Vodafone's crosshairs. And here's where it gets really interesting. Look at how they were structured. They were worlds apart. Vodafone had this lean, mean, agile board that was all about one thing: shareholder value. That's the classic Anglo-Saxon model. But Mannesmann? They had this complex German dual board system where employee reps actually held half the seats on the supervisory board. This wasn't just a difference in org charts. It was a fundamental clash of cultures just waiting to explode. So you've got these two titans on a collision course, a focused global hunter versus a transforming national champion. All it took was one big move on the corporate chessboard to light the fuse on the largest hostile takeover the world had ever seen.
And this was the spark. In October of '99, Mannesmann makes this unbelievably bold move and buys the British mobile company Orange for $33 billion. Now, for Vodafone, this was basically an invasion. A German rival planting its flag right in their home turf. They saw it as a direct threat, and they knew they had to do something, and fast.
This timeline just shows you how quickly it all went nuclear. I mean, look at this. It's a matter of months. November 14th, Vodafone launches its hostile bid. It gets rejected. Just 5 days later, they come back with a higher offer. The price just keeps going up and up and up until finally, in early February 2000, Mannesmann's board caves and accepts a new record-shattering deal. You know, this whole battle wasn't just fought in fancy boardrooms. It was a public war for the hearts and minds of shareholders, played out in the media. Vodafone even ran these cheeky ad campaigns in Germany with slogans just like this one, kind of poking fun at the Mannesmann name. Okay, so after months of public brawling, a deal is done. Vodafone has won, but the price they paid for that dominance was just astronomical. So let's pop the hood and really break down the anatomy of this deal. All right. This is probably the most crucial thing to understand. It was an all-stock deal. Vodafone wasn't paying with stacks of cash. They were paying with their own shares, which, remember, were trading at these insane, dizzying heights at the absolute peak of the bubble. They were essentially printing their own super valuable currency to buy the company. And to get Mannesmann's shareholders to even consider selling, they had to offer a massive, massive incentive. We're talking a premium of nearly 150% over what the stock was worth before the whole thing started. And this right here just shows you how nuts that number really was. You take the final offer price of over 350 euros a share, you subtract what it was trading at before the battle began, and you get a premium of almost 150%. They were paying 2.5 times the company's undisturbed value. Just wild. So this led to one of the biggest accounting entries in corporate history. Over £83 billion of something called goodwill was put on Vodafone's books. Now, in plain English, that's the intangible value. It's the price they paid above and beyond the actual market value of all of Mannesmann's physical assets. It's basically the pure cost of the premium. So Vodafone got its prize. They paid the price, and they built their massive pan-European empire. But what happens when you build that empire on a foundation that's made of a stock market bubble? We all know what happens to bubbles, right?
This slide tells the whole story, right here. The ink was barely dry on the deal when, pop, the dot-com bubble burst. Just look at that cliff edge. The new combined company's value peaked at over $350 billion in March of 2000, and then it just fell off a cliff. By the end of 2002, more than half of that value had just vanished.
And for Vodafone's original shareholders, the pain was immediate. This chart shows the company's earnings per share, which is basically how much profit each share is entitled to, and it just craters deep into negative territory. This is what we call a dilutive deal. Think of it like a pizza. The flood of new shares they had to print to buy Mannesmann meant the profit pie was now sliced into way thinner pieces for everyone.
But here's that paradox again. Despite all that financial carnage, you just can't argue with the strategy. From that perspective, Vodafone got exactly what it wanted. They got their pan-European dominance. They became the world's #1 mobile operator. And they got the massive scale they needed to be the leader in the coming 3G revolution.
Which brings us right back to our central question, a strategic masterpiece built on top of a financial Hindenburg. So, at the end of the day, who really won this thing? Okay, so let's look at the final report card. From a business operations perspective, the results were just staggering. This chart shows turnover skyrocketing over 300% in just 4 years. Their customer base grew by 241%. No question, the deal created an operational juggernaut with scale that nobody could match. But then you flip that report card over and you see the other side of the story. For shareholders, it was just pure value destruction. We're talking deep net profit losses year after year as they had to write down that massive goodwill. And of course, a stock market valuation that just crashed and burned. So when you boil it all down, the conclusion is pretty simple. The winners, without a doubt, were the Mannesmann shareholders. They got to sell their company at the absolute tippy top of a bubble for a historic premium. And the losers? They were Vodafone's own shareholders, who paid that premium and were then left holding the bag when the whole market imploded. And that leaves us with this final, really provocative thought. When a company pulls off a move that achieves every single one of its strategic goals, creating a global empire that dominates its industry for years, but does it at a price that absolutely devastates its own investors, what does it truly mean to win?